Hi, Steve Van Metre here, and welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night to answer your questions and try to make sense of markets that don't make any sense. And certainly, there's a lot of things that don't make sense. But what I've got on my mind is inflation and bonds. And you probably know, if you've watched this channel at least once, that I probably have bonds on my mind. I know. But it's okay, because we've got some really good stuff for you. I am going to answer some of your questions. And for those of you who I promised I would answer your questions in tonight's video, I'm apologizing. I'm going to push them back a little bit, if that's okay. Because not only do we have the data to go over from Friday from the banks, we've got the hedge fund data, and we've got a lot of stuff to go through that I want to get through. But the good news is I will not forget to answer your questions. And for those of you who are new or have a question, as long as it's not trading advice and I have a reasonable shot at answering it, all you have to do is send me an email or send me a message on Facebook. Again, I do not turn on the comment on YouTube. I just don't have time to go through them all. But if you have a question, let me know. I'll put you in the queue and we will get them answered no matter what. All right, so let's start out by talking about what happened over the weekend. JP Morgan Chase came out and tightened lending standards on 30-year mortgages, or I don't know if it was specifically 30-year, but it was on mortgages. They now require a 700 credit score and 20% down. Now, we have not heard from other banks, but we'll presume that other banks will tighten lending standards as well. Now, the question I'm going to ask for you is, are tightening lending standards bullish or bearish for yield? Because as a macro investor, you have to be able to figure out what all this stuff means. So if a bank is tightening lending standards, it means they're going to have less loans. If you have less loans, interest rates go down because they're cherry picking. That's what it means. Interest rates go down because fewer loans are being created, less money is being created. Now, there's some evidence to support this. Now, unfortunately, the Fed's data on residential loans does not really go back far enough. So I'm going to cheat and use commercial industrial lending tightening standards. And here in blue, this is shown inverted. So normally in a recession, tightening standards, let me say that again, normally in recessions, standards for loans tighten and they go up. So I have them inverted, and you can see going into recessions, they're actually collapsing as we would expect. And we see just, not a whole lot of data available, but based on the data we have from the Senior Loan Officer Survey, lending standards tighten during recessions. Now, why might that be? Because banks don't want to lend money out on a depreciating asset. So if they believe home prices are going to go down, which they are, they don't want to be caught taking a loss or a bigger loss than they need to by lending out money that they shouldn't have. And you can see in red are interest rates, and rates go down when lending standards tighten. So right now, lending standards are fairly neutral. We would expect as they go down, that will put downward pressure on interest rates. So there you go. That helps with that. Now, the second thing on my mind from this weekend is the OPEC Plus meeting, where OPEC Plus agreed to a 9.7 million barrel per day cut, with I believe 3.5 million coming from additional 3.5 million coming from the United States, Canada, and I think Brazil, or it could be Mexico. No, maybe it's Mexico. Yeah, I'm pretty sure it's, now that I think about it, is Mexico. And the market, it didn't really care for it. In fact, to show you where crude oil ended up today, it traded down and closed at just under 22.5 a barrel. Now, why is that? Well, simple. The answer is there's 35 million barrels less demand, and a 10 million, I keep saying billion. We're not talking about the Fed, we're talking about barrels of oil. A 10 million barrel cut, assuming that everyone does cut, and I'm going to assume the United States, Canada, and Mexico don't fully participate, and everyone knows that many of the OPEC nations don't fully participate in these cuts, even though they're supposed to. That's not enough to offset the lack of demand. It's just not going to work. The oil market knows it. And of course, what do lower crude oil prices mean for interest rates? You've got it. It puts downward pressure on yields. All right, let's get to some of your questions, and then we'll jump into what I've got for you. Steve, thank you for your excellent videos. Very educational. Thank you very much. I appreciate that. Question: what can we look at for confirmation the bond yields have bottomed out? Here's a couple of them, and I'm going to talk more about this on Friday. You want to look for peak unemployment, and this is going to be one of those things that I expect as the economy eventually reopens, the employment level is going to come down, but it's still going to be high. Peak cash and money markets, rising stock prices, increasing demand for credit. That's a big one. I mean, that's how you really know that the bottom is in. And not a short-term bottom, but more of a cycle bottom. Easing lending standards, that's definitely one. End of the recession, it tends to bottom shortly after the recession is over. So those are some things that I would look for. Steve, is it theoretically possible for the Fed to prop up the economy to the point where we won't see any lows that we saw in the previous month? No, I don't think so. This is a dream of Keynesians. Our monetary system follows Keynesian economic theory. The notion is that you can smooth out those undulations in the economy by printing money or lower interest rates or whatever magic wand the Fed's got. It doesn't work. It's never worked. But hey, you never know. This could be the very first time in history. So my comment is no, this is a dream of central banking, and in the history of central banking has never been achieved. Monetary policy cannot create demand or make consumers spend. So you can lower interest rates all you want, but you've heard that phrase, you can lead a horse to water, but you can't make it drink. I can lead a consumer to an electronics store with low interest rates, but I can't make them buy. I can take them to the car lot, but I can't make them buy. I can take them to look at a new home, can't make them buy. So all the Fed do is can lower rates and keep lowering them until finally demand comes. And this will be the last question. And again, we'll not forget the rest of you that sent questions, and I've got them all queued up. Can you show how much is the total supply of U.S. Treasuries in U.S. dollar in the world in your next video? I'll do my best. I tried Googling it, but couldn't find it. No, I've tried too, and you can't. Also, is there a chart to know what percent is owned by who? No, there's not. So the best way we can find this data, let me switch over to the browser, is one, we can look at where commercial industrial loan, or banks, not loans, banks, under non-mortgage backed securities, they're sitting at about around up 920 billion. We can look at the major foreign holders of treasury securities. Now this is lagged, but they're at 6.8 trillion. So we can add, say 920. So we'll say 7.7 trillion dollars, somewhere right around in there. And then we can look at the Federal Reserve. They're sitting on 3.5. So that's what? 11.2, 11.3 with all the rounding in there. That's held by three sources that we know of, and the rest of it out of the 24 trillion and growing is obviously held by investors out there somewhere. And I did not mean to close that browser window, so let me go reopen that, and we'll come back to your questions again on Wednesday and Friday, and if necessary Monday. I am committed to answering every one of them. All right, let's get into the banking data. We'll jump into the PowerPoints, and we're going to really take a look at why bond prices are going up. And then on Wednesday, we're going to come back full circle on and take all the data we looked at today and apply it to gold. Because yes, I do have the gold playbook. We are going to go through it. You're going to see why whatever point in time in history that I created some of this, it was actually fairly genius and it's actually fairly accurate. And I'm going to prove it to you in an undeniable way that should show that my view that gold should go down is right. Should. I'm not saying it will. Should. So stay tuned for that. All right, let's jump into the credit data. So as we look at securities and bank credit, we notice the banks are holding less bonds. And that happened not because of Treasury and agency, or I'm sorry, mortgage-backed securities, which they took on about 12 more billion of those. They had a big drop in Treasury securities and their non-mortgage backed. They dropped, like about 47 billion, somewhere right in there. And that's significant, but not when the fact that the Fed is actually buying 30 billion of these a day. You say, wait a minute, I thought they were buying like 50. They were. There's a shortage of treasuries. Can you imagine a shortage? I mean, who would have thought? Shortage of treasuries? You've got it. So now we know where these are going. It's not creating inflation. The banks aren't selling them to raise cash to lend out money. No, there is a shortage of bonds. And it makes sense because, when you take the macro view, you always have to be what I call connecting the dots. You have to, make sure everything lines up. So why is JP Morgan Chase Bank cutting lending standards or tightening them? I guess not cutting is the wrong word, tightening lending standards. Well, obviously, one, given the economic climate of the coronavirus. How about number two, the Fed's buying up all the collateral. See, if you have a 30-year liability, you need a 30-year asset to match it. Well, the Fed's buying up all the assets, and now you're stuck with liabilities and you don't have as many assets. Guess what you got to do? Take on less loans, or cherry pick and only take on stuff you feel super, super confident about. So that's pretty interesting, and we see that validated in the data here. They did pick up some other non-government insured mortgage-backed securities, and oddly some non-MBSs. These are agency securities from state and local governments. So all of a sudden the banks are buying these. I don't know if they're using these as collateral or if they are buying them because they know the Fed's probably going to buy them at some point or through a special purpose vehicle. I don't really know, but it's pretty interesting to see what was really something they didn't buy a whole lot of. They kept it fairly flat. Now they're increasing that. Let's take a look at lending. Of course, there's a big jump in loans and leases and bank credit. And where's it coming from? Commercial industrial lending. This is not coming from demand. It's coming from corporations drawing what's called their revolvers or their credit lines down and to use the money to hopefully stay in business through all this going on. And we do see an increase in real estate loans, but not from residential. Now that's interesting. Not from, but where we see it a little bit from commercial real estate is where we're seeing most of it come from. That's very, very interesting that commercial real estate is seeing an increase there. Maybe it's refinancing here. I don't know. I don't really follow the commercial real estate markets. I can't tell you. Consumer loans have decreased mostly due to credit cards. So it tells you, you can't just look at one data point and make your macro view. You have to look at lots of them. So you say, okay, well, there's a lot of the borrowing going on for commercial industrial loans. Is it validated that this is just them borrowing off their revolvers? Yes, it is, because credit card demand is falling. We don't see any surge in automobile loan or other commercial or other consumer loans or anything like that. A drop in credit card loans. Again, if consumers aren't spending, now you've got a problem. All right, so let's go and jump into the PowerPoint. And what we're going to find out pretty quick is which chart Steve accidentally deleted off his screen when he figured out the first time he recorded this video a little while ago, he forgot to hit record. All right, the money supply, growth rate is up to 14.57%. We know the Fed is easing, and we see this is growing mostly because money is flowing into institutional money market accounts. The monetary base is skyrocketing from QE. This is not a surprise. I said this would happen. What's really cool is the monetary base used to be updated every 2 weeks, and now I've forgotten they're updating it. They got a new data series every week. Really cool. I expected this. All that to say, the money multiplier is down to 3.68, and this is deflationary. This is very deflationary. But I'm going to prove it to you because that's what we need to do. Let's go look at the consumer price index. And you can see outside of the 70s when we had inflation and early 80s, because we went off the dollar standard in 1981, recessions are always deflationary. You see a drop in consumer prices. Let's zoom in to just the last financial crisis. And why is that? Because we're in a world of quantitative easing now. The game has changed. You can't go back and look at other events and say, well, that's what's going to happen. The Fed has changed the rules. You got to update your rule sheet. You have to. So you see this big drop in consumer prices. In fact, it went all the way down to -2 on a year-over-year basis. So let's do this. Let's take that money multiplier in blue and overlay consumer prices. And what do you find? Aha! That the money multiplier is deflationary. And this is really cool because right now the whole world, in terms of investors, are betting on inflation. They're saying inflation is coming, the Fed's printing inflation, inflation. You look everywhere, everywhere. And this lone guy on YouTube is saying, no, it's deflationary. It's really good for bonds. And then the market's saying, no, that guy doesn't know what he's talking about. Okay, look, there's a proof right there. The money multiplier goes down, and so too does consumer price index. Now, what is the money multiplier? Let's go back and just let me clarify this for those of you who are new. What this means, the technical definition of this is how many times a bank can lend against its deposits, 3.68 times. The Steve definition of this is when someone borrows money, it exchanges hands 3.68 times before it dies. And how does money die? It gets paid against the principal of a loan. So when the Fed, who is trying to create inflation, they end up creating deflation. See, monetary policy isn't exactly what you thought. It doesn't work the way the Fed always thinks. In fact, they have to ease enough and create deflation until they create inflation. So you can see here, the money multiplier is saying there is deflation coming. And when you know that, when you understand that, what does that tell you interest rates are going to do? They're going to go down. And if you understand the stock bond interest rate rule, what does that tell you? Stocks are going down. That's how you know. The Fed's going to crash the stock market. Pretty cool, huh? All right, let me see what other charts I've got. Okay, back to the PowerPoint. Again, if I would have actually hit record the first time, I wouldn't feel like I'm slightly lost this time. All right, let's take a look at the lending data. Again, real estate loan growth is flat. We kind of already saw that. Nothing going on in the real estate market from a consumer perspective. It's all coming out of commercial industrial lending. This is an anomaly. This is not showing demand. Loans and leases at all commercial banks, again, anomaly in the data. Here's where the rubber starts to meet the road. Consumer loans, credit card growth rate down to 1.96 from a year ago. Bye-bye economy. Again, you can give the consumer low interest rates. You can hand them money, but if they don't go out and borrow and spend, it doesn't mean anything. And there you go. All right, I want to fast forward this to the next location we're going to need. All right, and to the browser we go. Now, let's continue on this theme of how goofed up the Fed is and how many people do not understand how the real market works. Interest rates lead inflation. So when interest rates go up, you can see in the 70s and early 80s, inflation went up. If you're using consumer price index as your gauge of inflation, which the Fed is, so well, they use a variation of it, but it's the same difference for our perspective. And look, as interest rates go down, what happens? So too does consumer prices. So you can safely say that when the Fed lowers interest rates, they're creating deflation when they think they're creating inflation. It's bizarre, but it's true. So we already know interest rates are going down. We can tack on that by looking at a chart of crude oil, because remember we looked, I think on Friday, we looked at a chart that said there's a very strong relationship between crude oil and the consumer price index. And look, crude oil is saying, hey, consumer prices, you're coming down. After all, crude oil is used in lots of stuff not only we buy, but we consume. So it matters. When crude oil prices go down, so too does inflation. Now this gets really interesting, because I'm not done carrying this theme through, because it takes us to what are called real yields. And real yields are telling us that bond prices are going to go way up. Now I want to go back for those that missed this, and I want to just refresh your memory on what real yields are, because it never hurts to kind of look at these things multiple times. So what is real yield? It's a Fisher equation which says real interest rates equal the nominal rate less the inflation rate. Okay, so what can the nominal rate be? It can be 10-year treasuries, could be 30-year. The inflation rate is going to be the consumer price index. So let's look at an example, a made-up example. We have a 5% return, less 7% inflation, and that would tell you if you own bonds, you're taking a loss because inflation is outpacing your interest rate. So in that case, investors would be shorting the bond market to drive interest rates higher than inflation. That's what you would expect to happen. But anyways, let's forget about that. Let's take a look at bond example number 1, which we will use real live data. So today, the 30-year treasury yield is 1.4%, or just under that. Whereas inflation, 1.5%. So 1.4 minus 1.5 gives us a negative 0.1, meaning the real yield is starting to turn positive. It's getting close. It's heading up. And this is really important, okay? because a lot of people don't think what can happen is going to happen. What if inflation goes to 0? Remember, it went to -2. Okay, hang on to that thought. So you have 1.3 minus 0, we get a 1.3 positive gain. So if inflation, which I just showed you, is going to go down because the Fed is driving the money multiplier down by easing, it tells you that bonds are going to show a net gain when everyone thinks they're not. Let's go to example number 3, a deflationary example. So what if, in fact, for fun, let's put in some real data. Let's put in today's I don't know if you can see what I'm doing quite here. And let's put in the negative of the last financial crisis, but I'll bring it back. Hang tight with me. And boom, there we go. So let's say we take 30-year yields at 1.4% today. Subtract a -2. That gives us a net gain of 3.4 in terms of real yields. For bonds, it's massive. See, everyone thinks this is a terrible time to buy bonds. They just think inflation's going up, and they're wrong. Now we can look at real yields here, and we can say, well, wait a second. Real yields are going down. They're starting to go up. They're starting to go higher because the consumer price index is coming down. We can also somewhat predictively look at this. So let's go in here and let's take out consumer prices, right? Because what did we say is a good proxy for the CPI if you needed one? Whoops. How about WTI? So let's go put crude oil in here. We'll add that in. Change it to percentage change from a year ago. And I need to do A minus B. Aha. So what is crude oil telling me? That real yields are headed higher. And if I know real yields are headed higher, guess what it tells me I at least have in my portfolio? Bonds. Isn't that pretty cool? So it tells us everything. And that's kind of how you take a macro approach to the world. Look, it's like driving down the highway. You can see the exit coming up, right? Because you're not looking like right in front of you. You're looking down the road. And depending on how fast or slow you're going, it'll depend on when you get to the exit. We know the exit is there because we know what the Fed's doing. We just don't know what day it's going to happen. But we do know the setup is there for bonds. That's pretty cool, isn't it? Now, let's see. Did I save the... Okay, so where am I? Oh, you know what? It was on the real yields chart. Yeah, I changed that. Let's go back. Yeah, let's put this back the way it was real quick. There's something else I wanted to explain to you so you understood it. So what's going to happen with bond prices? So how do you know what's going on here? So the key is you have to realize is the interest rates lead the CPI. It's like the Fed doesn't know this for some bizarre reason. Okay, don't know why they don't. If they knew it, they would be hiking rates. So what happened here? This is where real yields took off. This was a big move in bond prices or big collapse in interest rates during the great financial crisis. See, we're right on the cusp of that happening right now. There was a secondary move here. What happened? Well, interest rates actually went down. Do we have a chart of... Yeah, here. What happened? Interest rates went down. Let me clear off that so we can see. So you can see interest rates rebounded up. Oops. During the middle of the great financial crisis and then went way down. So what's this move higher here? Well, it comes back to the secondary move right in here where yields were starting to rise and the consumer price index was starting to turn around. Because remember, consumer price index follows yields. This was your move in bonds. This was your second move down over in here where they actually did bottom out. Pretty cool. So now you know. But let's add to that because speculators or hedge fund managers, they're into this game too. And what they're setting up is a big, big monster move down as well. And I found this interesting when I looked at the Hedgeopia data this weekend. In fact, when I first pulled it up, I was like, whoa, look, they're really short, or they're not really short 10-year treasuries. Gosh, I wonder what they're doing with 30 years. So what this tells us is the hedge funds are not really betting big on the 10-year bond moving. but they're massively betting on the 30-year bond going way down in value. In fact, they're their second largest short position in history. Meaning, if we go back and look at their former largest short position, which is very close to where we're at now with the exception of this 1 week drop, they took yields when they backed off of that and went fairly neutral from 3.5 to 2.5. So if we do a similar move, you can look and expect 1.4 to 0.4. That's a big move in bond prices. If they actually go net positive beyond this little move here, you're talking 30-year bond at 0 just on a speculative move, which is completely validated by the money multiplier, what the Fed is doing, and real yields. There you go. You've got it. That's the macro view. You got to look at everything and build your thesis. And I think that's really cool because this tells us everything. These speculators are betting so heavily on what's going on with the 30-year, they're failing to understand one important thing. The 30-year is getting stuck at 1.4. Why? Because that's when the Fed dropped that big rate cut bomb of 4 cuts on Sunday night back in about a month ago. And it created roughly, other than this initial move higher, it created a ceiling on how high yields go. So even if it does break through 1.4, say in the next day or two, it's unlikely to hold. And we know that because you can go right back and look at the speculative positioning and say, hey, there's so much speculative positioning. Yeah, they can take it lower, but there's not much left they've got. They've got this thing pedaled to the metal for the most part. And guess what they're getting for it? Nothing. They're really accomplishing nothing. They have been trying to short this thing up. They've been trying to drive yields up, and they're putting a lot of money behind it and getting nowhere. So now you know when these hedge funds get squeezed out of those short positions, and inflation continues to fall because the Fed is easing, that yields are headed down, and quite possibly, as I predicted, the 30-year could get to 0. And that would be huge for the bond market that nobody sees coming. And even better, virtually nobody owns. Hardly anybody owns this thing. Most investors don't own bonds at all. So if you start to see money managers start to buy bonds on top of it, it just supports the whole view that I put together for you. All right, back to how hedge funds are positioned. They've increased their longs in West Texas Intermediate crude. Good luck to them. If they unwind these positions, you can see why crude alone is going to 0 just from a speculative positioning. Doesn't mean it'll be a buy then, because you need consumer demand to really drive crude oil prices up, and we're not seeing that today. So hedge funds went net short on the S&P as it went up, which is interesting. Because they actually increased their short volatility positions, which doesn't make any sense. Gold went down. Now, stay tuned. And I don't think I mentioned it in this version of the video. And if I did, I've forgotten already. I'm going to come back and talk about gold in a big way again, kind of wrap this whole thing up, tie it into real yields, and give you my reason why. Yeah, I got the gold playbook out. I still don't remember when I created this thing, but it's right. And I'm going to prove to you, once again, it's right, and why gold is more, in my opinion, is likely to come way down before it makes its big move up, and then what could cause it to make an even bigger move higher. So stay tuned for that for Wednesday. Plus, I'll get to more of your questions as I promised, barring something very exciting in the economic data, which I'm not anticipating. NASDAQ 100, they reduced their longs a bit as it went up. Russell 2000, they backed off their shorts. You can see the hedge funds are completely wrong on this recent move, but that happens sometimes. US dollar, they're fairly neutral. Dollar breaks 103. Well, all hell is going to break loose on the market. And as I mentioned, they increased their shorts on the VIX as they increased their shorts on the S&P. Doesn't make much sense to me at all. But I think what's coming up in bonds is very, very, very cool. All right, one last quick chart, and let's go look at, the S&P 500. Finding some brief support here at 2735 today. Trying to go higher, but remember, as long as yields are headed down, stock prices do follow. So what are we seeing in the market? Stocks are trying to go up, right? Market wants stocks to go up. And so it's trying to force yields higher. But it's not working. not working for it at all. That's how you know it's going to reverse. Anyways, I appreciate you taking the time to watch. Appreciate you sending me the questions. I will get to those if Wednesday, if not Friday, and perhaps Monday, because I got a whole bunch of them. But thanks for taking the time to watch. I'm Steve Van Metre, and I am off my game a little bit at the moment. The content of this video is provided as educational information only. It is not intended to provide investment or other advice. This material is not to be construed as a recognition or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in this video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.